I'm James Gruber. Welcome to the morning report for Monday, the 2nd of March. There have been some extremely serious developments out of the Middle East in the past few days, which will impact markets here in Australia and around the world, as investors weigh up the impact on the supply of oil. On February the 28th, the US-Israeli airstrikes targeted Iran, and Iran responded with strikes on Israel and US bases in the Middle East. The tit for tat has continued, with recorded fatalities including Iran's supreme leader. This has all unfolded while the majority of markets have been closed. Prior to the conflict, index futures for the Australian share market were down 0.2%. 2 days feels like a long time in markets, right? It's likely to be a rocky start, therefore, for the ASX this morning. Bitcoin was one of the only major assets trading over the weekend. It sharply slumped when the Iranian conflict broke out, then recovered after the Iranian supreme leader was killed. That may indicate that markets expect a short and sharp conflict. What we know today is that the hostilities should benefit the likes of oil, defence and gold stocks. To recap how the ASX 200 finished the week, it did close up on Friday, gaining 23.3 points to 9,108.60, which set a new 52-week high. Over the 5 days to Friday, our index gained 1.2%, and it finished February 3.7% higher. February is a big month, as you'd know. It's packed with corporate results. February also marks a third straight monthly gain. To commodities. Commodities will be in everyone's sights because of the impact of the military action on key supply areas for oil. Global oil prices rose about 3% on Friday ahead of the weekend strike against Iran. Brent crude oil settled up 3.2% to $72.48 a barrel. It's likely oil prices are going to go higher today again. The Strait of Hormuz is closed, meaning disruption to oil supplies. Lower supplies versus demand means higher prices. The length of the conflict will play a role too. Developments are changing by the hour. Copper futures hit a 4-week high on Friday and a 7th consecutive monthly gain as demand optimism outweighed concerns over stocks piling up. Copper futures finished up 0.9%. Gold prices rose to a near 1-month high on Friday and a 7th straight month of gains, supported by geopolitical tensions ahead of the weekend strikes. The futures finished up 0.4%. Iron ore futures, though, finished down 0.4%. Let's look at the currencies. The Aussie dollar was down 1.2% at last trade to 70.49 US cents, and that's because the US dollar is seen as a safe haven, particularly amidst this conflict. Let's go back a step to see how Wall Street and other markets finished the week before the weekend's airstrikes. On Friday, the Dow Jones index was down 1.1%, the S&P 500 index was 0.4% lower, and the Nasdaq index declined 0.9%. There are some developments worth highlighting. Wall Street lenders on Friday were rocked by the implosion of little-known UK mortgage provider Market Financial Solutions, fueling concerns about wider losses among banks and reviving warnings of more so-called cockroaches in the booming private credit industry. It led to a broad sell-off in financial firms and alternative asset managers as the market grapples with the prospect of widening credit contagion amid concerns about lending standards in the industry. Apollo fell 8.6%, Goldman Sachs was down 7.5%, while KKR was off 6.3%. Meanwhile, the information technology sector declined 2.2% as AI implications continue to worry investors. Nvidia, the world's largest stock, ended 4.2% lower. Markets weren't helped by new economic data showing prices paid to US producers rose in January by more than forecast, fueled by services and pointing to lingering inflationary pressures. The producer price index increased 0.5%, the most since September, after a revised 0.4% increase in December. The 10 other S&P 500 sectors outside financials and tech finished up, with healthcare and energy leading the way. The benchmark 10-year yield fell below 4% for the first time since late November, as investors remained on edge over geopolitical tensions in the Middle East, while a sharp sell-off on Wall Street further dampened risk appetite. The US 10-year Treasury yield fell 6 points to 3.95%, while the US 2-year Treasury yield also dropped 6 points to 3.38%. To the European markets, They closed at a record high on Friday and their 8th straight month of gains after better than expected corporate updates, while heavyweight banks tumbled amid credit and AI disruption concerns. Banks dropped 1.7% in their steepest one-day decline in 2 weeks. Barclays fell 4.2% after the collapse of the UK mortgage lender that I mentioned earlier. Santander shed 2.8% as it owns Atlas SP Partners, a lender to MFS with other banks. Investors flocked to healthcare and food and beverage stocks, up 1% and 1.5% respectively. The continent-wide FTSE Euro First 300 index ended up 0.1%, while the UK FTSE 100 was 0.6% higher. What are we watching for this week? Well, besides monitoring developments out of the Middle East, there's lots of business as usual. Reporting season is officially over, but some companies will release results this week, including Life360 tomorrow and Endeavour on Wednesday. We've got another inflation update too, this time from the Melbourne Institute Inflation Gauge. It's tipped to rise 0.7% month on month. That's today. Tomorrow it's building approvals for January. And there's a big data point on Wednesday, economic growth. GDP for the fourth quarter, CBA economists predict a 0.7% increase quarter on quarter. And on Thursday, we'll get the trade balance for January. Goods trading surplus is expected of $4.2 billion. CBA economists say last week's private sector capital expenditure figures and construction survey imply that real business investment growth was weak in the fourth quarter of 2025 and barely contributed to GDP growth. That follows a very strong contribution in the previous quarter, partly driven by temporary factors. The unwind of these temporary factors was the primary driver of the weak data. The economists say the lead-up data suggests GDP growth will print at 0.7% in the fourth quarter of 2025. We'll also be looking out for household spending for January. December was minus 0.4% month on month and plus 5% year on year. There'll also be important economic releases in the US, including the manufacturing PMI on Monday, ISM manufacturing and services on Monday and Wednesday, the ADP employment change on Wednesday, and non-farm payrolls on Friday. That's it for today. For further developments on the local trading session, please tune into the CommSec Market Update podcast this afternoon, and of course, the Market Close video. Have a great day.